What a day this was. I'm sure most everyone has seen the headlines at this point, but man, do we have a tariff news update today. Markets rip higher as we get a stay of execution on the worst of the reciprocal tariff plan, or do we? That's where we find ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We're going to unpack what that was just now in the financial markets and take a look at what it might mean once the speculative dust settles and the spotlight turns back to what this story is really all about, the U.S. economy and what these tariffs might be expected to do and why the markets have been upset about them in the first place. We, of course, are going to get exactly that sort of a check on the environment as we get U.S. inflation data coming at us in less than 24 hours. So let's break this down. We started off this week talking about where the markets landed with last week's blistering sell-off. And we noted, as the week was getting started, that the markets stopped at a very auspicious spot. And that in this spot, you were probably, as the markets refused to break past it on Monday, you might see some kind of a recoiling because it seemed as though the news had not improved, but the market had stopped selling. And indeed, right on cue, this ends up being a place where the markets turn. Let's zoom in here on the active contract for the S&P 500. This is the ES future for June, and this is the daily chart. This was a weekly one right here. So here we can see where we started the week and where we are today. Here we can see where we started the week and that stalling, that stop in the sell-off that we were just mentioning. And then, of course, today we rush back higher. No, we stop right at the underside of the preceding leg down. So just at the spot where we get Liberation Day. That's this right here. This is where the sell-off really garners steam last week. And here's the preceding leg of the initial decline, where we find a little bit of a reprieve before Liberation Day, when, of course, the tariff plan is unveiled, and the market clearly has a hard time digesting it. So, what to make of all of this? Well, the rally comes as the president comes out and says that reciprocal tariffs, which were supposed to get introduced today, into practice with all of their varied rates across many economies, will not, in fact, go forward as such. It will go forward, but only with a baseline 10% tariff rate for all trading partners. But China, since it has already retaliated to the president's actions, will instead face a 125% tariff, which is an increase, and at this point, these numbers are hovering somewhere in the realm of the mythological. At this point, we might as well say it'll be a 500% tariff, or a tariff rate of a bajillion and one. It looks very much like now the stage is being massaged to some kind of negotiation, and clearly those countries that didn't retaliate, it is being shown, see reprieves occur. And so the upshot is that the tariff threat has been watered down some, but more importantly, that the amount of consternation in markets has been enough that there is, in fact, a reaction function from the White House. We've heard all through this decline last week and going into this week that the weakness in the stock market was going to be overlooked, that this was par for the course for implementing this new policy, and that the dust would settle and things would be okay. Today, we see that the level of pain grew too much, and we get a step back that ultimately speculative interest likes very much. And so we get this dramatic rally, and that makes sense. But where does this leave us? Well, the place where this move lands seems very appropriate to start that discussion. Again, we land not with a new high, but with a volatile reversal that nevertheless leaves the breakdown intact. We retest the underside of the preceding range. We fail to make it over. Does that mean we won't make it over necessarily? Well, of course not. But what we still see here is a trend lower. Lower lows, lower highs. And then we start to consider the upshot. Why didn't the markets sell off on tariff news in November when they knew that some sort of tariff regime was coming? That was here. Markets were not upset here. Why not? Because it's not the tariffs they're upset about. It is the uncertainty with which fiscal policy, as epitomized by the tariffs, has been put forward. And so it is not until mid-February, late February, when business confidence surveys like the PMIs, consumer confidence surveys like the one from the University of Michigan and the one from the Conference Board start showing that all of this policy uncertainty is starting to end up with lower economic growth expectations, weaker sentiment, and decelerating growth. It is not until then that the markets start to care, which is here. And so it is the uncertainty of execution that really seems to bother investors, not the trajectory of the policy goal as such. And so with that in mind, we look at what today's announcement brought, and it was another U-turn in a policy that looks no more predictable now than it did yesterday. Moreover, what we find is that we still have the same basic architecture of the economy before or after this. Consider, this is the GDP Nowcast from the Atlanta Fed. And again, as we've said a lot here on the show, it's not about the level. It's not about whether the economy shrinks somewhere between 0 and 1% if you discount the impact of gold imports recently, or between 2 and 3% if you don't discount them. That's not really what's important here. These nowcasts take in information sometimes daily, sometimes every several days, depending on when the economic data comes out. We will surely have an update after this incoming batch of data this week, but it's not the absolute levels that matter. Those will change as that data is factored into the model. It is the direction of the data. And we can see here clearly from February, about the middle of February, right here, the data begins to aggressively deteriorate to show not that the tariff policy is negatively impacting things, but that uncertainty about fiscal policy, including tariffs, is putting a dampener on economic activity. And that's why the sell-off kicks off here and not earlier. And with today's announcement, that uncertainty has not been in any way relieved. consider what happened on Liberation Day itself and this upward wick on the S&P. Why does that happen? Because initially, when the president comes into the Rose Garden and says we're going to have a 10% broad tariff, market actually likes it. It is not until he comes up with the foam board with the multitude disparate rates country by country that things become not to investors' liking. Because if there is a blanket tariff, well, then at least it's forecastable. And that's all that the markets seem to want. A runway and a pathway for businesses to follow whereby uncertainty can unclench, whatever the outcome. But that is not what we have here. What we have is another sort of situation where we seem to be moving the goalposts frequently, and businesses and consumers are going to have a hard time extrapolating forward. And of course, by extension, likewise, the markets. And so once the dust settles on the speculative element of this, we are left with this. An economy that has started to significantly decelerate because of uncertainty. And while policy expectations have meaningfully unclenched as well, as of yesterday, the first rate cut was already on the menu for May. It is now back out to about July to be fully discounted. Moreover, the amount of rate cuts has significantly come down. But if we actually look at the total tally, we can see here yesterday into today, it is barely changed. In fact, it's been barely changed for about a week, where the markets are looking for essentially 5 rate cuts with some room for error to the dovish side between now and the end of next year. What's changed is that yesterday and the day before and toward the end of last week, the market saw many more rate cuts coming in 2025, 4 of them, and maybe between 1 and 2 next year. Whereas now we have 3 coming this year, so 1 less, and 2 with some optionality for a 3rd next year. In other words, all the markets have done as a consequence of this announcement is take 4 rate cuts for this year and 2 for next, 1 and 2, let's say, and move the cut back by a year and said it's not 4 this year, it's 3, it's not 2 or 3 next year, it's 1 or 2. And so the makeup has ostensibly moved to a somewhat less urgent setting. But the upshot that we need 125 plus basis points, 125 basis points would be 5 cuts, and again, with a little bit of optionality for a 6th. That's what we need, whether you sequence it this way or that. But the total has largely remained unchanged, and most importantly, that total is greater than what the Fed has in mind. The Fed forecasted in December and then reaffirmed at its latest meeting in March from 4.4 on the headline rate down to 3.9 this year, that's 50 basis points, out to 3.4 the following year, that's another 50 basis points. That's 100 basis points between now and the end of next year. The markets are obviously 1 rate hike or 1 rate cut and some change to the dovish side of that. And that has not been altered. It's just now the markets see more cuts later versus sooner. Moreover, when we get the minutes from that March meeting today, amid all of the uncertainty, and amid all of the swings back and forth in stock markets around the president's announcement, what we find is that the mood for policymakers in March mainly was a troubled concern with inflation. We have here growing concern about inflation persistence amid trade policy uncertainty. Almost all participants viewed risks tilted to the upside for inflation and down for employment, with the outlook for real GDP growth weaker than January. And of course, participants linked all of this and said participants observed that the inflationary effects from tariffs could be more persistent than projected. In other words, the inaction we've had from Fed officials around all of this speaks to their concern that the tariffs might be bigger and stickier in their upward in their upward impetus on price than they were anticipating. But of course, the markets have taken it a step further. What those Fed minutes tell us is they tell us what the Fed was concerned about and why they are not cutting rates, or at least signaling that they're ready. But what the markets are saying is that the hit to growth from these tariffs will be so great that their impact will be disinflationary. That is to say, the tariffs will raise consumer prices such that consumption takes a hit, investment takes a hit, growth overall is dragged lower, and the hit to demand is so severe that inflation actually goes down because whatever uplift from the tariffs is more than overwhelmed by the pull that weak demand and recession have going the other way. And so if the Fed minutes establish for us why the Fed isn't cutting as of March 19th, this collapse in break-even rates since early April is telling us the Fed's wall of worry need not be there, because the market is telling them that inflation expectations as a consequence of this are going down and not up. With that, of course, the incoming inflation report becomes absolutely critical. We're expected to see a downtick, 2.6% on the headline figure and 3% on the core. For the headline, that would be the lowest since October. For the core, that'd be the first time we see a 3% at the figure reading there since April 2021. So this is significant disinflation being signaled here. Moreover, if we look at the dynamics and the trends that the Fed likes to watch here, we can see that if we get another downtick, it would mark a third consecutive month after January and February that the trend in annualizing 3-month and 6-month changes in CPI might imply. So we see here the sort of internal dynamics of where inflation is going. What the Fed likes to do is take the 3-month change and annualize it, both for the headline and the core, and kind of get a sense of the dynamics. And what we see here is for 2 months now, the annualized 3-month rate, headline and core, lower. 6-month rate, core, lower. Headline 6-month looks about the same, but certainly not rising. In other words, at the start of this year, we start to see inflation begin to roll over downward, and this would be a third consecutive month of seeing that, even, again, as these break-even rates are telling us the inflation scare is leading to lower inflation expectations as a consequence of the tariffs, not the other way around. So the barriers to the Fed moving from here, 100 basis points, to here, a more dovish setting where the market is pulling them, might well be breaking down. And if we were to get a CPI report that endorses that, we might certainly see evidence as much. Now, of course, what that would imply, as we've seen over the recent months, is that the economic hit is already underway, hence the disinflation. We've seen that it has come mainly over the past several months at the expense of core services, which is where growth has been and what has led to the U.S. economy outperforming as well as it did last year. And so the upshot here may well be that this rally, while certainly a breath of relief for sentiment, is only that. And what it is an opportunity to get back short, looking for a more orderly move like this to reflect the economic reality of what's occurring, because that hasn't changed, even though the sentiment piece might have become less vicious. That is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back in just 30 minutes time here for the Price of Truth with Victor Jones. I'm back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sunday. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.